Welcome, everybody. My name is Justin Krupp with Groundfloor. We're at the top of the hour here, noon Eastern. Wherever you're calling in from, thank you so much for your time. We're going to give this a couple more minutes. Typically, in our experience, when everybody launches a fresh webinar program, it takes a little while to adjust the system. So we're going to give this about 2 more minutes. I'm looking at the attendees based on the number of registrations. We've got quite a few people that are probably looking to trickle in. So bear with us for about 90 seconds or 2 more minutes, and then we'll get going. All right, I'm still seeing a lot of folks trickling in. Just another quick announcement. We're going to give it maybe about another 30 or so seconds, let a couple other people jump on. Typically, when you launch a GoToWebinar, it's fighting your systems with Zoom or Google or whatever the case may be. So another couple seconds and we'll get going here. Still see a lot of folks trickling in. Once it maybe slows down, we'll get going here. Maybe another 30. Hopefully everybody's having a good day so far. Well, I think what I'll do, maybe in the interest of everybody's time, I'll start my preamble because you guys aren't really here to see me. We've got a really great agenda with 3 of my colleagues lined up for you today. So welcome officially to the Groundfloor Masterclass webinar. We'll be talking about market outlooks, investing on the platform. We are actually coming to you live from our headquarter offices here in Midtown Atlanta. And thank you so much for dedicating the time. Again, noon Eastern time, and wherever across the country you may be calling in, maybe even across the globe. We've had about over 700 people register for this webinar. And in advance, during the registration, we had asked all of you to volunteer some questions. And about over 100 of you had submitted questions in advance of this webinar. And so what we're going to do, or what we've at least aimed to do here, is we've gone through those questions in advance. And so instead of doing a Q&A at the end, what we've done is look through those questions and address many of those and bake those into the content. And so for those of you looking for something specific, hopefully we've done a good job here and bake that into the content. And for those questions that we don't address, or the ones that maybe didn't quite fit into the overall agenda, we'll look to answer those in different formats. As many of you know, we, on a monthly basis, we send out our asset management update. And maybe for this coming month, for the November's edition, which we're working on actively right now, we'll maybe have a Q&A session into the end of that. So with that, let's get going. And I am thrilled to at least introduce the agenda here for you. And we've got 3 really great content sections that are set up for you. Firstly, we'll be kicking off with Patrick Donahue, who is our VP of Market Risk. He'll be going over the real estate market outlook for you guys. With that, then he'll hand it over to Joey Wilson. Joey is our VP of Customer Success, probably a name that many of you are familiar with, maybe you've even spoken to him. He'll be covering our investor tools. And then Reed Shermer, our VP of Real Estate, he'll be bringing us home with a final section here to talk about portfolio management and our asset management team. And so with that, we're going to dive right in. I know many of you guys are still trickling in, but with that, I'm going to hand it over to Patrick, who's going to talk about real estate market.
Good afternoon, everyone, and thank you, Justin. My name is Patrick Donahue. I'm the Vice President of Market Risk at Groundfloor. I've been at Groundfloor for 7 years. I've worn many different hats, and I look forward to discussing here with you what I've been working on recently, which is standing up a market risk environment department and how we're set up to help investors make good choices with data-driven information. So I'd like to start with what was a key decision from the market risk department that helped investment committee navigate some of the waters of the headwinds that we saw in 22. And certainly there were. It was a bit of a roller coaster year, as we all can relate. But one of the main drivers from the data that we were to gather and understand from many sources was that we reduced and restricted our lending guidelines. We took our heavy rehab and new construction requirements and we increased the borrower equity. We reduced high leverage products. We paused high leverage products, the loan 100 and the loan 90, and our loan to cost overall was reduced in almost all loan categories. And we did this because we felt, based on conditions, based on where we were at as a company, that it was prudent to pull back. And investors should know that that is a main way in which we control risk. We get together as a group, we look at data, we look at sort of read the tea leaves and see what's out there. And for the investors, you should know that these guidelines did not increase our production, but these guidelines actually saw a reduction in the production, and that was expected. And we made that choice. We made that choice because the market and other concerns were telling us so. So let's talk about data. I look at a lot of data. I look at a lot of data that you as investors send in through the form of questions. I know that we all get data sort of heavy, right? There's many sources of data that come out about the real estate market, some good, some not so good. But we absolutely look to many sources of data. Zelman and Associates, for instance, is a equity consultant that produces amazing housing research. CoreLogic, Moody's, John Burns Consulting, Altus Research, Redfin. These are just a few, but these sources are vital for us to look at data across the board to help make better decisions that are going to affect performance of the LROs for our investors. So let's look at a specific example, the FHFA House Price Index, which is the Federal Housing Price Index. And we can see that here in Atlanta as an example. The Atlanta house prices rose 16.1% over the past year and fell negative 1.2% over the last quarter. And it's the 19th of the top 100 metros. And we also see that in the United States, across the nation, house prices rose 12.4% over the past year and 0% over the last quarter. And I believe that's 43 consecutive quarters with positive appreciation and 8 consecutive quarters with double-digit growth nationally. Pretty amazing run. So why I like this index is that the mortgage and appraisal data used in this specific index and how information is calculated comes directly from Freddie Mac and Fannie Mae. And that data is more robust and pertinent than the assessor data used by other popular indexes because it's more pertinent to our business. It's more pertinent to the evaluation of housing prices that correlate best to our debt investments. So let's take a look at that. So fully 77% of loans with an ARV less than 500,000 have an ARV average of 386,000. Now, why this particular index is so strikingly positive for us is that Fannie Mae and Freddie Mac are conforming lenders, so their loan amounts generally cover, properties that are not the luxury tier of the market, but the middle tier of the market and the lower tier of the market, which is, as you can tell, what our LROs are collateralized by. So when I look at these indexes and I say I compare, you can see on the chart the Case-Shiller index against the FHFA index, you can see there's a difference, especially in the past quarter, where Case-Shiller was just very solid down to the right. And that was because of the influence. What that tells me is that the influence of luxury markets drove that index down, whereas a more accurate perspective that we took was from the blue line, which is the FHFA index, and we can tell that had a flat experience this year. So for investors, you should know that we want to not only look at multiple sources of data, but we really want to look at what's pertinent to the LROs and the performance of the LROs, and reading the tea leaves about markets and setting lending guidelines and policy appropriately. And so let's go ahead and take a look at what's probable in the market. So this is something that I, in my capacity here as market risk VP, I think in terms of probability, and I think in terms of what I can understand in probability as a lead driver and how I'm looking at markets and how I can affect better decisions across the organization for investors. And I do see in probable in 23 is that interest rates are likely to stabilize. Interest rates, rising interest rates, they've been a headline since early in the summer and continue to be so. And in fact, yesterday, Chairman Powell was up talking about reducing the how much the raise was going to be in December potentially, and that they will soon be pulling back in the Fed funds rate and how much they're raising it. That is very good news. Certainly the equity markets responded well to it, and for us here at Groundfloor, our investors, our borrowers, we certainly see that stabilization of interest rates in Q3 would be a benefit both to borrowers. It would be a signal to the markets that sort of perhaps a bottom in rates is in, and probably a signal to first-time home buyers to increase their looking and affordability coming in more relative to probably where it should be. Also, as I look ahead, inflation clearly was the catalyst for all of the motion in the market, all of the headlines. It was the reason why Chairman Powell began to raise rates, and it's what created a lot of the headlines in the news. So when I'm considering, what's probable, I would look at inflation in 2023 from an investor standpoint and say, where do I think inflation is going to be? Is the Fed going to be successful in taming inflation? Well, I do know this. They will not stop raising rates until it is tamed. So we know that that's probable. And by recent data, we can understand that the beginning of this reducing of inflation has most likely begun, and time will tell. But for me, probability suggests that by the end of Q4, we should see the inflation rate being near target or headed that way. So, as investors, what does that tell us? As investors and borrowers and market participants, what does this tell us? Well, it tells us that the roller coaster that we saw in 22 and will probably likely persist through Q1 of 23 is likely to normalize. And in a normalized market, we can make better decisions. From the borrower standpoint, the borrower can make acquisitions, make informed acquisitions with an understanding of where their ARV is going to be in a much better way when interest rates are in check and inflation has been tamed. Certainly, we could see unemployment rear its ugly head in 23, and that could change the outlook. But certainly, taming of inflation gives borrowers, investors, market participants a much more normalized viewpoint from market terms. So let's look at uncertain times as it relates to home flipping. Our LROs are backed by properties that are being flipped. And recent history suggests that actually home flipping is very profitable in uncertain times. If we look, this is a 21-year history of gross profit and gross ROI for home flipping. The green spiked line is ROI and the gross profit is in the blue bars. What I really want to focus on is this red box. This was right after 2008, one of the worst recessions in history. And you can see there was this troughing process. And then prior to home prices being appreciative across the board, you see real estate investor, home flipper, gross ROI really go on a significant positive increase from 2009 straight on through really to 2014. So what does that tell us? Well, it tells us that in bottoming, troughing markets, we can really see how very good acquisitions can lead to very good ROI. And perhaps I didn't know this data 7 months ago, or maybe you didn't know this data coming in, but I can tell you that inherently and intrinsically, the borrowers, the real estate investors, the performers on the LRO repayments, they get this, and they require capital. And when I'm looking at this from a standpoint of should we be bullish, should we bearish, should we be neutral, what I want to see is I want to see a troughing market, and I want to see this green line go up for borrowers. And because I know that that's going to result in the successful repayment of LROs. And, that is really what I wanted to cover today. And I really greatly appreciate your time. I would encourage you to provide feedback relative to data that you see in the market so that we can, put it into, our wide pan of different data sources. And we, really always appreciate any communication or interaction with Groundfloor as a whole. And so thank you. And I'm going to introduce my handsome colleague, Joey Wilson, and I wish you guys a great day. Thank you.
Thank you very much, Patrick. It's great to be here with all of you. I'm Joey Wilson. I'm head of Groundfloor's customer success team. I've been with Groundfloor for about 4 years. I've spoken with many of you, and those that I haven't spoken with, I'm sure many of you have spoken with members of my team, our investor services team, and hopefully we've been providing some really great support over the years for all of you. So I'm going to talk a little bit about the tools that our investors have access to with Groundfloor. And I'll start with just the basics of what Groundfloor offers. Our Groundfloor's mainline investment product is the LRO. The LRO is a limited recourse obligation, which is a proprietary security created by Groundfloor that offers short-term, high-yield debt investments backed by underlying real estate assets for which Groundfloor holds the first lien position. So Groundfloor allows our customers to create their own custom portfolios of real estate investments that are all backed by real assets. And we're in the first lien position on all those assets. Just real basic, Groundfloor originates and funds loans to real estate developers, creates those securities, creates those LROs, They're all qualified by the SEC, and then we release them to the crowd for funding. And that's where you come in and you fund those LROs. So a couple of features of our platform, in addition to just you being able to create your own custom portfolios, consistent 10% returns. So we back test our portfolio, and I'll show you some of the data in a little bit, but our average returns over the years have been consistently at 10%. Now, we've raised interest rates, we've lowered interest rates early in, around COVID. We raised interest rates in July. We're actually raising rates again now, going into effect today, another 100 basis points. But recently, while our returns have been consistently at 10%, more recently our returns are closer to 11, even 11.5%. Regular cash flow as a feature. I'm going to talk a little bit more about this, but Groundfloor, by investing over time in many loans, you start to create regular cash flow akin to a dividend, a REIT type dividend. No fees. We have never charged fees to our investors for investing on Groundfloor on our platform. We make all our money off originating and servicing our loans to our borrowers and do not charge fees to our investors. And the idea that you can create your own portfolio, you're not paying a portfolio manager, allows us to pass those yields 100% to our investors. As I said, investments are secured by real estate property, first lien position. And lastly, what I wanted to point out, and I'm going to talk a little bit about in a minute, is this $10 minimum investment. So what does that mean by $10 minimum investment? So a $10 minimum investment sounds great as a low barrier to entry on Groundfloor. It's all you need to set up a Groundfloor account. But I like to say the $10 minimum is a low barrier to diversification on our platform. Why is diversification so important? I mean, this is, not to take it for granted, but this is investing 101. Investing in many LROs on Groundfloor, or investing in the stock market using Groundfloor as an alternative or other alternative investments as a means of diversification reduces volatility. And you see this in our data. Again, we back test all our portfolio performance. And what we see is if you invest in 50 LROs, 50 LROs will yield predictable returns. So we'll effectively move that investing beta and start to generate predictability in your portfolio. If you invest in 100 plus loans, and I'll show you this in an illustration in just a little bit, your returns will start to cluster right around our average, which has been 10%. The $10 minimum enables that diversification. So it allows you to invest in many loans with your capital, whether you're investing $1,000, $5,000, $100,000. And then recurring investments start to generate regular cash flow, as I said earlier. So here's a cool chart. Looking at our portfolio, if you just look at the portfolio with 1 to 10 LROs repaid, you'll start to see like a very wide range. That's where there's little predictability in the portfolio performance. So, the rates, the 5th percentile, 6.5%. By the way, 6.5% is not bad. But the idea here behind this illustration, behind this chart, is to show you the lack of predictability when you're investing in one loan, and then how that starts to narrow and it starts to become more predictable as you invest in 50 LROs, 100 LROs, then 500 plus LROs. And this is a great chart. If you guys aren't familiar with our portfolio analysis that we do, we publish it twice a year. We are going to be publishing a new one shortly. But this is a diagram that's in our portfolio analysis. So each one of those little dots is an actual real portfolio on the Groundfloor platform. And you see on the x-axis the number of LROs invested in, and you see on the y-axis the returns for those LROs. So I love this chart because you can see here when you get to 50 LROs invested in, you start to see it cluster around the 10% mark and that predictability being reduced. And then when you get to 100 and 100 plus LROs, all those dots are clustered right around the average return of the portfolio. So really highlights the effect of diversification. And then this is just an illustrative example to show if you had a portfolio of $5,000 and you invested, you had a max LRO investment amount of $1,000 that you wanted to put into every loan, you're going to be over concentrated in each LRO. So each LRO will make up 20% of your portfolio. The effect of that is, our loss ratio is really low. It's, I think, 0.3%. It's very low. But if you happen to be in one of those losses, and that's 20% of your portfolio, you'll feel the effect, you'll experience the effect. Whereas if you're diversified into 50 LROs, 500 LROs, because you're putting smaller amounts into each, you are not going to feel that effect as much. And that's where those returns start to cluster right around that 10% range. So we have 3 tools, and I'll walk through these a little bit quickly. I have committed to doing a deeper demo, an actual demo of how to invest and kind of investing for beginners on Groundfloor in the future. So I'm going to move through these a litlittle quickly. But the beauty of this and why I love this chart is because, you know, it really shows that Groundfloor allows you to invest and participate on your terms. And, you know, we've mapped those on a scale of customization, how customized you want to make your you want to build your portfolio, and then the ease of diversification, which you see on the x-axis. So the first way a lot of people invest is the do-it-yourselfer, the do-it-yourself way. They'll hit our portal, they will assess and do due diligence on individual LROs that they want to invest in. They will dig into the LRO, they'll look at the risk grade. The risk grade is our proprietary algorithm through which we rate the risk of a given loan. And they'll look at the factors that make up that risk grade, and they'll invest, which is great. That's a great way to build a custom portfolio, but very hard to invest in many loans because you're spending a lot of time looking at each individual LRO. Our investment wizard. I love the investment wizard. The investment wizard allows you to deploy large amounts of capital or even small amounts of capital across many LROs very easily. So what you would do is you see the 3, but it's a little small, the diagram, but you see the 3 boxes. The 3 boxes correspond to investment strategies that correspond to risk tolerance. So you could choose if you're a conservative investor, if you're a dynamic investor, a little less conservative, and choose one of those and enter how much money you want to invest. And the investment wizard will deploy your capital across many LROs. You can also click the link just above those strategies and start to play with, and that's why this is a little more configurable, start to play with the toggles and the settings, and then use the investment wizard in that way. And if any of you have used our mobile app, the mobile app is built on the investment wizards. The mobile app is designed to be very light and allow you to invest large amounts of capital across many LROs. And lastly, auto investing. So I personally use auto investing. Auto investing allows you to input the maximum amount you want to invest in any letter grade. So going back to that chart, if it's $10, $100, $1,000 if you have a large portfolio, and the tool will automatically invest your funds into LROs. And the automatic investing engine runs, I believe it's at 8 o'clock. It runs every evening. And also every time loans are released, it'll sweep your account and deploy your capital into LROs automatically. So this is the secret sauce for what I like to call passive cash flow investing. Invest set dollar amounts on a regular basis over time. We have a tool that allows for that called the recurring funds transfer tool. So the recurring funds transfer tool allows you to set an amount you want to transfer into the platform on a given day of the month. And then if you're running the recurring funds transfer tool and the automatic investing tool, that's kind of our version of passive investing and set and forget. It allows you to deploy capital over time, have the tool invest for you, and you know, invest and diversify your portfolio on your behalf. And I was just working with an investor, and this is when you start to see, you know, real cash flows start to develop as you invest over time. So I was talking to an investor, working with an investor just last week. It was a real world example. That investor has an account that was $35,000. They have been investing for about 4 to 5 years. And over time, just continuing to invest, and the account's built up to $35,000. And they were looking at their, we have this weekly, I'm sure many of you receive it and have seen it, we have a weekly summary repayment email that shows your repayments for that week. They had accrued $800 in cash in that week, which is extremely powerful. That is, you know, 10 times the return of a REIT dividend at $800 to $1,000 a week on that $35,000 account. So real cash flow. And then investing over time allows you to, reduce the volatility, avoid what, when we call timing the market, and minimize risk. But generating that cash flow is really, really powerful. So I'm going to leave you with that. In summary, $10. Why is $10 important? It's a low barrier to entry, but more importantly, a low barrier to diversification. 50 LROs, 100 LROs. That's when you start to improve the predictability of your portfolio and your returns and start to zero in on our average. And then lastly, creating cash flow, being able to invest on your terms, and if that's passively, using our tools that allow you to diversify and invest passively in our platform. So I'll leave you with that, and I'm going to turn it over now to Reed Shermer, who is our VP of Real Estate. Talk to you a little bit about portfolio management and asset management.
Well, thank you, Joey, for that. I really greatly appreciate that. I'm going to go ahead and move this forward. Good afternoon, everybody. My name is Reed Shermer. I'm the Vice President of Real Estate here at Groundfloor. I've been with the company for about 1.5 years now. Been in real estate for over 20 years. I've worked with home builders, asset management firms, property management firms, and I'm really excited about what we're doing here in the asset management space with Groundfloor. You know, we have an incredible asset management team that executes a robust and strategic approach to managing the entire portfolio in an effort to maximize returns for you, our investor. I'm going to share with you today some of the great work that we're doing with the asset management team and what we're doing to manage your investments. Want to take a couple moments to talk about our team. We have a seasoned, dedicated team of not only asset managers, but construction professionals as well. The team is broken into 4 distinct groups. The primary servicing team handles those current loans, the ones with the statuses that are current. Those are performing LROs that have active renovation projects going on and have yet to reach their maturity date. Each individual LRO, each individual asset has a dedicated asset manager communicating and coordinating with those borrowers on a regular recurring basis, tracking performance, production, and touching base with them when things don't seem to be progressing as quickly as we'd like to see them. After that comes our special servicing team. That team is dedicated to focusing on those loans that have gone into what we call an extended status. Those are loans that have eclipsed their maturity date, but yet progress is continuing. Work is being done, draws are being taken, the borrowers are working feverishly towards completing their projects and either getting them on the market for sale or looking to refinance them and repay the loans with Groundfloor. That special servicing team focuses on extension management as well as define borrower engagement to touch base with them on a monthly basis and make sure that those loans are progressing towards repayment. The third part of our asset management team is our default servicing team. They handle the loans that have matured, the borrowers are unable to pay, and unfortunately, at this point, Groundfloor has had to engage an attorney to file a legal foreclosure action on that borrower. There's still communication going on. The borrowers are still able to refinance those loans. The borrowers are still able to sell those products and repay Groundfloor. And we're going to talk about that in a few slides. Additionally, the default servicing team also handles those properties that have gone through the foreclosure process, move into what's called REO or real estate owned, where Groundfloor now is in complete possession of the property. We prepare the property for sale and market. We then go ahead and list it and sell it. The fourth team that we have is our construction management team. And these are dedicated, seasoned construction professionals that not only review budgets, but they're reviewing the draws that borrowers are making as they're progressing with those loans. I do want to take a minute and talk about the draw process a little bit because I think it's important. The draw process is a method in which the borrower requests for reimbursement on work that they've completed. The borrower pays out of pocket for the work to be completed, requests the refund from Groundfloor. Groundfloor then sends out a third-party inspection company to put eyes on the property. We do an interior and an exterior inspection, a report's produced. That report is then provided back to Groundfloor and our construction team reviews that. We make sure that we're tick and tying the progress together with the amounts that have been requested. Once we've confirmed that, then we'll go ahead and release the draw, that payment back to the borrower, so they could pay their subs and continue on their project. On average, each property gets about 5 to 10 of these inspections during the life cycle. That gives us a tremendous opportunity to really see what's going on inside, outside the project, and to ensure that the work is being done per the original budget and scope of work. I'm going to go ahead and move on to the next slide. And this is actually probably my favorite slide. The graphic depicts our entire portfolio. Currently, we've got just under 1,300 assets that we have under management right now. The funnel shows how the vast majority of our loans are performing or extended, or in a status called extended not performing, which I'll explain in a moment. As you can see, you get back down towards the bottom of the funnel. It shows our portfolio that's in default and then our portfolio that's in REO. I know REO for some folks could be a very concerning term, but rest assured, a very small percentage of our portfolio actually winds up in REO. In fact, 93% of our loans, of our LROs, repay prior to ever going into default. And you can see that how that's depicted there. Now, a couple of numbers that I do want to share with you. So you have the current performing loans, which are loans that are clipping along, progress is being made, draws are being taken, the borrowers are doing exactly what they're supposed to be doing. Those extended performing loans, those are loans that have met some macroeconomic headwinds coming out of COVID, post-COVID. They had permitting delays, supply chain issues, material issues, labor issues. So there was the need for those loans to need a little more time to get completed. Now, we're tracking along, we're in very close communication with their borrowers. So those extended performing loans are doing exactly what they should be doing. They just needed a little extra time. In order for those borrowers to continue to receive those draws, we require what's called a forbearance agreement, which is an agreement between the borrower and Groundfloor that they are going to keep progressing. In addition to that, additional interest points are applied to those loans. And those interest points and all that interest that's earned in addition to what was contracted goes directly to you, the investors. The extended non-performing loans, those are loans that have taken longer than they should have. Those are loans that are 180 days past maturity. The borrowers are starting to struggle and they're looking to exit those loans. Most of those loans will look to refinance, but I want to draw your attention to a couple of the key points here. So 70% of those extended non-performing LROs repay in full, principal and interest, prior to them ever going to default. And that is a direct result of the constant and committed communication that we have between our asset management teams and those borrowers. For those loans that do go into default, 75% of those repay with interest, with full principal and some, if not all, interest prior to ever going into REO. And those LROs that find their way, unfortunately, into REO, still 67% of those that repay back to the investors receive a 75% or greater principal recovery. The 2022 performance is very exciting. So we had 970 loans repay so far in 2022. There's still more time to go, and we're expecting an exciting December. But of those, you could see that if you take a look at the extended, the actual return has been higher than the expected return. And how can that be? How can the actual return be higher than the expected return? And there's a reason for that. The reason for that is, as I discussed, those forbearance agreements that the borrowers enter into with Groundfloor in order to be able to continue to take draws after the loan has matured, there is an additional penalty fee that's applied to that. Those additional fees are passed on directly to the investors, improving the return for you. A vast majority of those extended loans repay within a few months after maturity, and you benefit from the additional interest accrued during that time. So those are some very exciting numbers that we've seen in 2022, and those numbers are directly the result of the hard work that the asset management team is doing on a day-to-day basis. I'm going to go ahead and provide a few. This is probably my favorite slide. This is the results slide. So The repayments chart shows from May of 2021 until October of 2022. And these are the repayments, and these are in millions of dollars. So as you could see, as we continue to expand on our asset management team and grow and hire seasoned professionals to come in and really work with borrowers and hold folks accountable, the repayments continue to grow. As a result of that, the interest earned continues to grow. That penalty interest applies. Also, the chart on the right, the interest earned is also in the millions of dollars. And what's really important here is that 100% of the interest that we receive from the borrowers is passed directly to you, the investors, as my colleague Joey had mentioned before. It is a tremendous opportunity, and we understand the fiduciary responsibility that we have to you, our investors. And so with this being my final slide, I wanted to show the results of the hard work, the organization, the dedication that the asset management team has put into play and actions on every single day. In conclusion, appreciate the opportunity to provide the support and solutions to not only our borrowers, but our investors as well. With that, I'd like to turn it back over to Justin Krupp to wrap us up for today. It's been a pleasure and an honor to be able to present to you today, and I look forward to delivering even better results in 2023. Thank you.
All right, thank you, Reed. Guys, thank you so much. They're still here in the room with me. So a couple closing comments, but that does conclude at least the core of today's session. But a couple closing comments. First and foremost, I've got a slide up here, and if you guys wanted to jot down, Patrick, Joey, and Reed have made themselves available, at least via email here. If there's anything that had been discussed in any of the 3 sessions that you feel you want to reach out to them individually and directly, we invite you to do so. I think you all understand we take lines of communication and feedback very seriously here at Groundfloor, and so we invite you to reach out to us, whether it be to these guys individually, or as you know, you can always reach out to our support team at support@groundfloor.us as well. So please utilize those forms of communications. This webinar hopefully will be has been recorded, and so please look for an email probably end of day today or maybe first thing tomorrow, where we'll send out a thank you email with a direct link to this video. If there's anything that we've covered in any of these sections that you wanted to revisit, you'll have that link to be able to access that video. Couple other comments regarding questions. So again, I had alluded to in the very beginning, and very appreciative of the over 100 of you who had submitted questions in advance. Those questions were incredibly informative and helped us build out this content. And of course, we didn't necessarily get to all of those. And so as I alluded to earlier, we will aim in the coming days or weeks to revisit those questions and answer those in certain capacities, as well as what Joey had mentioned. I think some of the conversations that we're having internally is where we're going to be doing some additional webinars, where it be these topics specifically, where we can do deeper dives, like with Joey doing a real live demo into the investor tools and getting a really deeper understanding about some of the tools and features that he discussed, among some other things as well. But please let us know if there's any other broad topics that you feel are relevant for subsequent webinars, or even other topics in general. There were a couple questions that had come up regarding product, and while we didn't necessarily get into a product roadmap conversation here, we have recently in the past weeks done a webinar regarding Groundfloor Labs, and so that program is still moving along. For those of you who were participating in that webinar and have actually signed up and utilized Groundfloor Labs, thank you so much. For those who don't know or don't remember exactly what Groundfloor Labs is, this is our proving ground, where we are constantly with our product team developing new ways and new product opportunities for investments. And Groundfloor Labs is a way for us to introduce those products into a beta environment. So if you are an accredited investor and or a shareholder, you have access to that. If you are not, I will provide a link again in this email where we have a sign up form for any of those who are interested in looking into that a little bit further. And then my final comment would be is maybe in the spirit of giving for this holiday season that's upon us. Many of you probably are aware, but I wanted to give another shout out to our referral program. Any of you who log into your account and go to your investor dashboard, you should see a very blunt button at the very top talking about referral. So please utilize that link, share with your friends and family. For each successful referral, you each get a $50 investment credit. So please help us spread the word through the referral program, but also on social media as well. Any of our communications and our websites have our links to our social media pages, Twitter, Facebook, LinkedIn, and Instagram primarily. So please give us a follow as we are looking to continue to build up those channels and provide additional ways to communicate with you. So with that, we're going to sign off. Thank you again so much for your time today. Hopefully this was incredibly informative for you. And again, use these lines of communication as we are constantly looking to improve ways to deliver messages to you on an ongoing basis. So take care, everybody. Thank you so much.